Hi everyone, my name is Jadu Srikandan and I'm a buyer's agent for property investors. Today, this webinar is around the Australian property market and how you can make money in the Australian property market if you really understand how it works. So, we're going to talk about how these markets move, what trends they exhibit, and how you can capitalize on that. Now, this is not a typical sales presentation. There's nothing I'm selling here. It's purely educational. And if you can really understand the concept that I'm talking about here, I guarantee you, you will make a lot of money. So let's get into this. Now, what we're going to cover before we go into market movements, I just want to set some essential criteria that you need to have before you purchase an investment property. Now, this is what you need to do each time you're buying an investment property so that you minimize your risk and get a maximum return on your investment. So that's the first stage. We need to kind of really understand that first before we go into the market movements. And then once we've kind of really touched that and cleared that, then we're going into how the Australian market works. And finally, we're going into, a, into a city, Hobart, which really boomed in 2016. We're going to look at what caused it to boom and how you can similarly look at data indicators and trends and identify areas that are about to boom. So a lot of value and information in this presentation, and I'm really excited to start to present this to you. Now, let's look at some fundamentals that we need to apply each time we buy an investment property. So here at Property Framework, we apply all these principles below so that we minimize risk and maximize the return on your investment. So let's go through them one by one. So the first one is being able to buy property in a location that gives you really strong growth within the first 2 years. So I'm talking about short-term growth. So why is short-term growth important? Okay, we don't want growth after 7 years or 10 years. We want that growth immediate. And why is that important? It's important because your accumulation should happen really fast, and that's how you allow the magic of compounding to work on your portfolio. So to really understand this, let's take a step back and let's look at two different people, person A and person B. So person A, he buys a property in his first year and he buys it poorly, and the property takes 7 years to grow up in value. So he's only able to buy another property at the end of 7 years. But this time he buys correctly, and at the ninth and 10 years, he's able to buy two more properties. So at the end of 10 years, he's able to buy four properties. Now we have another person, person B, who applies these principles and then buys in good, strong growth location. The first property is really bought in a good location, which is growing quickly. So he's able to quickly get it, buy another property in the second year, and then buy again in the third year, and buy again in the fourth year. So within 4 years, he's bought four properties. Okay. Now, with properties, what happens is that when time moves by, you let the compounding effect of asset value increase and rent increase take place. So time is a big, big it plays a big role in the building out of a portfolio. So if you look at person B, he has more time on his hand because he's accumulated his assets faster. So at the end of 15 or 20 years, he would have, a higher asset value and more rents coming in his portfolio. So his cash flow would be better. So person B is in a much better situation. And that really emphasizes why you need to buy properties that are going to grow up value in the short term. So don't ignore short-term growth. Now, the next one, demand exceeding supply. And that's a very simple principle, right? Buy into areas where demand exceeds supply. So let's dig into this deeper. What is demand? Demand is usually created by people moving into an area because of job opportunities or because of changes happening in that economy, right? And when that happens, then there is, more demand on property because people need places to live. Demand could also be caused by affordability. People are priced out of the areas that they live and they want to move into more affordable areas. So that creates demand. Now let's look at an example like Adelaide. So this city over the like 10 years before, people were moving out of Adelaide. Adelaide was losing population to areas like Sydney and Melbourne because young people felt that there were more job opportunities in Sydney and Melbourne, and therefore there was Adelaide. There was not much demand in Adelaide for property, and but as time the last few years they started changing. The Adelaide economy started changing. There were more job opportunities there, and young people stayed on in Adelaide. And even people from other areas, they saw that Adelaide was affordable and there were more job opportunities over there. So they moved to Adelaide, right? And you can see how demand is being created in an area because of job opportunities and affordability. Another factor that you could look at is lifestyle, like areas like Sunshine Coast, Gold Coast. People from Sydney and Melbourne are moving into those areas because it offers that good lifestyle, and because of these work from home trends they can live there and work from home. So that's how demand is being created in those areas. So lifestyle is also another factor that creates demand. Now let's look at the other one, supply is created by the listings, the total number of properties for sale, the total number of rental properties available, and also the total number of new builds that are coming onto that market. So look for areas where supply is trending low. Now, if you take Perth as an example, as of recording in September 2023, Perth has really low listings. Perth has very low rental stock available and very low new builds coming into the market, and a really strong demand from both owner occupiers and East Coast investors. So there's going to be price growth in Perth because of this. So look at things on a macro level to identify areas where demand is going to exceed supply, and those areas will have price growth. Okay. The next one is cash flow. So cash flow is really, really important. Like if if you can't hold on to a property because the cash flow is poor, then you sell the property at a loss. And when you sell a property, you don't have, you don't have a portfolio, right? Let's take an example. You buy a property for 1 million and you're spending 20,000 each year. At the end of 4 years, you can't afford to hold on to that and you sell it off, right? So you've pretty much lost that 4 years because, that property, you couldn't hold on to it because of that high cost. Therefore, the question you should be asking is, if I buy a property, is the cash flow going to be good enough so that if my personal situation changes, I can still hold on to that property, and the property is going to take care of me rather than the other way around. So cash flow really becomes crucial when you're building out a portfolio. The next one is high rental demand. Okay, we want to buy in areas which have really strong rental demand. So rental demand is measured by an indicator called vacancy rates, and we want to buy in areas where vacancy rates are trending low. Okay, and rental demand is usually caused by similar things that we discussed before, like job opportunities and good facilities and lifestyle factors. So these areas will usually have a lot of rental demand, and get into areas where vacancy rates are less than 2%. So those are the areas that you should be kind of targeting. The last one, and that is really, really important, no incoming supply in suburb. Now the principles above won't really work if you have supply coming into a suburb. So how do you really quickly assess if there's going to be supply coming? So go into Google Maps, get an overview of that suburb, see if there's a lot of developable land, and then quickly call up council and see if what is going to be happening to this developable land. Is it going to remain as is, or are there going to be new properties coming there? So if there are going to be new properties, then that means there's more supply. And if there's more supply, then vacancy rates will increase and there won't be price pressure. So none of the above principles will really hold true. So you have to avoid areas with high supply coming in because that just reduces price pressure. Okay, so these are the fundamentals that you should follow when you're buying an investment property, and as long as you follow these steps, you are definitely minimizing risk and maximizing your returns on your investment. So it's a process that needs to be rinsed and repeated each time to get you the maximum outcome. Okay, now let's move to the next slide where we go into market movements and how property markets behave. Now, I'll split this into different states. So we're going to look at Queensland, New South Wales, and then on the next slides, we have some other markets as well. So what we see here, okay, now I've taken regional Queensland, Townsville, Rockhampton, Cairns, Brisbane, surrounding Brisbane, there's Ipswich, Logan, and then Toowoomba as well. So what we see from these markets is that between 92 to 2002, there was flat, it was flat, meaning was there was no price growth. Between 2002 and 2008, there was rapid price growth. Prices were increasing. And then between 2008 to 2020, nothing happened again. And now, 2020 to 2022, prices started increasing again rapidly. Okay. If you look at New South Wales, so I'm taking three areas: Central Coast, Wollongong, Newcastle. 92 to 98, slow growth. 98 to 2004, there was rapid growth. 2004 to 2012, nothing really happened. 2012 to 2017, rapid growth. 2017 to 2020, no growth or slight correction. And then 2020 to 2021, boom. Okay. Going on to other markets, let's just look at one more. Let's look at the South Australian market. What happened here is Adelaide. Let's look at Adelaide. 94 to 2000, nothing happened with Adelaide prices. 2002 to 2009, it boomed. 2009 to 2020, nothing happened again. 2020 to 2022, boom. So I think you get the point by now. What I'm trying to say here is that with each market, there are certain patterns. There are long periods where there's no growth. You can see that from what I just showed you earlier. There are long periods in property markets with no growth. And then there are those brief periods where there's rapid capital growth, really sharp growth. Okay. And what I want to emphasize here is that capital growth in a market does not happen linearly. So when you say the Australian property markets grow at 6% per annum, you don't get 6% growth every year. What happens is that you get booms and then nothing happens, and then booms and then nothing happens. And most of the growth happens during those periods of rapid growth or during those booms, which are relatively short. Okay. So if most of the growth happens during those booms or those short periods, then it makes sense for us to enter the market just before that boom is going to happen, or when it's just in that early stages of that growth cycle, because that's when most of the growth happens, right? So 6% is coming from there. That's why it's happening. So why would we want to go into a market when it's going to be flat for the next 10 years? That wouldn't make sense, right? To capitalize on the market, we need to get into the market when it's just starting its growth cycle. That's where you could get the maximum out of your investment. Okay. And you want that rapid asset growth, right? So to get that rapid asset growth, to build out a portfolio, then look to time the markets. Look nationwide in Australia. Look which markets are just going to boom or just going to start their growth cycle, and then get into those markets. And that one point, if you can just understand that concept, then that means you have really understood the key. And that is how you can be successful in property investing. Okay. Now, we spoke about how markets boom and they have long periods of flat growth. Now let's talk about an example. Now we know Hobart, right? Hobart is in Tasmania. It's a capital city there. And what happened in Hobart was that for a very long period, 2004 to 2016, there was nothing happening there. Like prices were flat. Like there was no investor activity there. Like it was. I mean, there was investor activity, but it was not as you know it wasn't very popular to invest. Let's put it that way. So what really happened was that in 2016, the market boomed. Like from no growth, it just boomed, right? Prices were around 400,000 in 2016. And then in 2022, they became 800, 900,000. So massive growth. So as an investor, people would be really hesitant to get into the Hobart market, because of those, long period of no growth. So everyone would be afraid to get into such a market. But if you can read the market, look at what is happening in the market, then you can see some signs. You have early signs to know that the market is going to boom. So, was it predictable? Absolutely. 100% this boom was predictable. The boom happened in 2016, but there were already early indicators as early as 2013. There was changes happening in that market. And if you can read those changes, right? If you can read those changes, then you can make money. Okay. So let's get into Hobart now. Okay. The first indicator, what happened in May 2013? Vacancy rates started dropping from a peak of around 3%. They started dropping down. You can see this trend line here 2013, and then the vacancy rates are coming down. So, what does it mean? Vacancy rates coming down means that the rental demand in that area is increasing. There's not many properties available to rent. Okay. So, why is the rental demand increasing? People are moving into Hobart for some reason. Probably because there are job opportunities, because, there are certain things happening in the economy. There are projects that are coming up, and therefore people are coming in to Hobart to take up these projects. And they could be coming in from within Tasmania, or they could be coming in from other states as well, or even they could be coming in from overseas. Whatever it was, there was people movement into Hobart, and that was why the rental demand was picking up. So that was the first sign. Vacancy rates starting to drop. Now the second sign, as the rental demand increased, you know, more people looking for a home, but very little homes available. The obvious thing would be for rents to start increasing. So around June 2015, rents started picking up in Hobart. So rents were increasing. Okay. Then what happens when rents increase? So when rent increase, the people who are renting out, they will look at the market and say, okay, we're paying so much, $400 a week for rent. We might as well just pay about $50 extra and then just own a property because our rents are so expensive. So people who are renting will eventually will eventually move into buying property, right? So there is that rental pressure transfers to sales pressure. So what you can see here is that the listings, the number of properties on the market is reducing over time. So which means that properties which were just in the market for long periods of time were being snatched up by buyers who wanted properties, right? The demand for property was increasing. Okay. So the supply of property was steadily reducing in Hobart. Okay. So what do you see here? Supply of property is reducing, an increasing number of people who want properties, rental properties or properties to live in. What do you think that is going to cause? You know, there's a big imbalance here. Low supply and massive demand. Yes, this is exactly what happened. Prices started surging from 2016. This is 400K. Prices just started skyrocketing in Hobart, and they became, in 2022, as of uh, now, it's around 800, 850K a median house in Hobart. Okay, so there are some early trends here. You can see the trends happening, and if you look at what happened on a macro level in Hobart, what really happened was that the economy was changing in 2014. The economic growth, the GDP, was rapidly increasing in Hobart because there were a lot of projects coming into that area. There was improvements in the healthcare and social assistance sector, manufacturing, construction. All three areas were booming in Hobart. This created more job opportunities, and that was what really caused this movement. Now you can see everything was predictable way before 2016. If you can understand what's happening in terms of projects on a macroeconomic macro level and also understand the data indicators which are showing very clear trends, then this boom was clearly predictable. Okay. Now, what I want to emphasize is imagine you bought a property in 400K in Hobart in 2016 with just a 40K deposit, 10% deposit. Now that property is worth 800K, right? So you've made 400K in 6 years, and that's 10 times your investment. 40K, you put in a 40K deposit and you made 400K, 10 times your investment. And that's how you make money in these markets, by really understanding the trends and the patterns. And the key here, Okay, let me emphasize. The key is to spot these markets early. Now, what we're doing for clients is exactly what I showed you here. Identifying things on a macro level, what's happening with the infrastructure projects, what's happening with the economy, and then looking at data trends. Are they showing positive signs? And if they're showing positive signs, yes, this is the market we're going to invest in, and our clients are going to make lots of money through that. So I hope you got some value from this presentation. You know, if this is something you like talking about, just feel free to reach out to me. I'll be more than happy to discuss this further. So until then, I hope you continue with your investment journey. And if you have any things that you need help with, then feel free to reach out to us. Thank you.